Welcome back. In this video, we'll discuss how to quickly gather feedback on your performance in Capsim by using the Foundation FastTrack report. This is going to be quite a bit longer than the previous videos because there's a lot to go over. It is good information, however, and I hope you will enjoy it. So to begin, I will be starting with a company that has already advanced to round 1. By clicking on the reports in Capsim, you open up the Foundation FastTrack report. Just to give you some context, this company is generally pursuing a niche cost leadership strategy. The firm has a single product that is being adapted to the low-tech market segment. At the top of this report, the first thing that may catch your eye under the selected financial statistics is contribution margin. The 20.1% value from Andrews, our firm, is lower than all of our competitors. This is potentially concerning. The next step is to find out why. Is this intentional? Is there something very wrong about the strategy we're pursuing? The next figure that might jump out to you is the sales figure. In contrast to contribution margin, you're actually in the market lead. We now shouldn't feel quite so nervous. At least our customers are buying our product. We still have more work to do, but this figure suggests we may be thinking strategically. Looking at the bar chart of percent of sales, we observe that our profit slice is the smallest, but our variable costs slice is the largest. That being said, the chart doesn't suggest we are substantially different from our competitors. Not that we would expect that to be the case soon after the industry breakup. Nevertheless, if we were in real trouble, we would probably be seeing a more eye-popping difference in this chart. The pie chart to the right reinforces what we knew from the sales figures, that we have a slight lead in the overall market share. Continuing down to the stocks and bonds section of the FastTrack report, it appears that according to the graph that no firm has yet been able to differentiate itself from the pack. Stock price is a function of earnings and shares outstanding. Of our industry firms, Erie seems to be falling off the pace slightly in terms of price. You may recall that Erie not only has a low contribution margin like we had, but also recorded smaller revenues. Taken together, this is probably why Erie has a lower stock price than the other firms. Below the stock price are the firm's bonds and their ratings. While knowing principal balances and interest rates for the various outstanding bonds is important, for the purposes of quickly evaluating performance, we probably care only about the S&P bond rating, which is a measure of how likely we are to default on our bonds. Bond ratings range from AAA at the high end, moving down through AA, A, BBB, and so forth, until we get to junk bond status. The higher our rating, we'll be able to issue bonds at lower rates. Though not an exact science, bond ratings are a function of how much debt we already have and our firm's current performance. Our A rating suggests the folks at the S&P think we are less likely to go belly up than any other firm in our industry. For the most part, I don't find the stocks and bonds section of this FastTrack report to be particularly useful in terms of decision making. There is nothing here you have direct control over. Bad news here is usually downstream from the decisions you've made and continue to make. But, as investor relations is a big part of management, it is something to continue to keep an eye on. The next section of the report is something that by the end of this course, you should be able to navigate relatively effectively. The financial summary includes the statement of cash flows, balance sheet, and the income statement. We will delve more deeply into this section of the report later. But for our quick assessment for purposes, we really only care about 3 numbers, technically 4. First, we look at the net change in cash position. Remember, the top priority of any business is to never run out of money. The negative value we see here, especially since no other firm is showing a similar loss, is concerning. I quickly look at the cash value just below at the top of the balance survey sheet, and I see that I still have over $4 million in cash. So although cash flow requires attention, it is not a cash crisis yet. The second figure to examine is net profit at the bottom of the income statement. This is the bottom line for the whole firm. Are we making money or are we not? Investors like big profits, but sometimes it is better for your investors, in the long run, to defer profits today so that you can realize bigger profits tomorrow. Of course, maximizing profit is considered one of, if not the biggest responsibility of the business leader. However, I've just told you that the net change in cash position is more important. Why is that? Simply put, cash is king. There is a common saying in the real estate investment community: you can't eat gold bricks. That is to say, currency can be quickly converted into food, shelter, and utilities. Non-liquid assets cannot. Liquid assets are the lifeblood of any business. Without cash, we don't pay our people, we can't order parts, we can't pay the tax bill. In the late 2000s, millions of people had millions of dollars of paper profits, stored into investments called collateralized debt obligations, or CDOs. These are investments made up of thousands of home mortgages and are secured by the homes that we're attached to. The thinking goes that if the borrowers stopped paying their mortgages, the homes could be sold and the holders of the CDOs could recoup their investments. The borrowers did stop paying their mortgages. Millions of people. All of a sudden, with millions of homes trying to be sold at once, prices which had been built up during the real estate bubble tumbled. Trillions of dollars of paper wealth disappeared, seemingly overnight. Investors, banks, hedge funds, and nations who had purchased billions of dollars of assets discovered they were actually worth a fraction of what they had paid for them. In addition, the loss of income from borrowers defaulting on their mortgages meant they had no incoming cash to sustain operations. Monolithic firms that had stood for over a century had to close and people lost their jobs. Those who had cash were able to buy up properties at a fraction of the cost they could have purchased them for only a few years before. This is the tricky part about looking solely at profit. Net profit creates a change in total assets. We assign an asset a value based upon what we think it's actually worth. However, we never really know the value of any asset until we try to sell it. The market determines its price. Of course, the more urgently we need to cash out, the worse our power position in negotiations may be, and the bigger bargain the buyer is likely to walk away with. Cash gives us time to find a buyer who is willing to pay more. Cash allows us to keep the lights on in the hard times, as well as thrive when the market inevitably takes a downward turn. Never forget that cash is king. The final metric to look at here is the total assets. But specifically, when doing a balance sheet analysis, we try to look at total assets year over year. When total assets grow at or around the anticipated rate, this is another good indicator of a healthy firm. Assets will generally grow as a result of capital investment and the cultivation of intellectual capital. So if this value is growing year over year, this suggests that the future performance of the firm will continue to improve. If this value is decreasing, this suggests the firm is cannibalizing current assets, which will negatively impact future performance. I also want to compare these key metrics to that of the other firms. Some of the best ways to draw industry intelligence is to examine financial statements and to see what they are doing differently. Are they putting more funds into large capital investments? Are they buying stock back? How is their cash flow? Are they paying less interest or taxes than we are? A financial statement can tell you an awful lot about a firm if you learn to read what it's telling you. We now turn our attention to the production analysis section of the FastTrack report. The top half of this section is a graphical representation of production and capacity of the assembly lines of the various firms. The blue bar shows the current first shift production capacity of our firm. The gold bar indicates the current level of production, which includes the second shift. For any round, the gold bar may be up to twice as long as the blue bar. For the first round, all firms have a first shift capacity of 800,000 units. Our firm chose to utilize 2 full shifts this round, and our targeted production was 1.6 million units. The bottom half of this section consists of production information. There is a wealth of information here about how well you and your competitors are functioning. I think it is worthwhile to examine this section. In reality, how much of this information can you actually put together regarding your competitors? The answer is not immediately clear. First, this is a special case. All of the firms that we have here have grown out of the same parent company, so the key design metrics are identical. In effect, each firm is going about setting up the problem in the same way as we are. Some of the biggest innovations in business involve adopting a paradigm shift in thinking about problems. Maybe a different firm wouldn't care about MTBF, but instead focus on single-use or short-term sensors. Maybe I can build a market segment that doesn't care about size at all. Nevertheless, we'll take these key metrics as a given. Would we be able to understand the performance criteria of each of the firm's products? Absolutely. I buy a few off the shelf and perform my own internal testing so I can understand each product's capabilities and characteristics. I, however, wouldn't know about products that are still undergoing research and development. The table accurately provides no information regarding the products in development, only giving us their product names. This is pretty spot on because we will often hear about products in development through publicity campaigns and in trade publications. We probably can get decent numbers on units sold and inventory from financial statements. We would already know the price and be able to make fair estimates of material and labor costs based upon financial statements. The biggest question I might have is that of the degree of automation and plant capacity. Some of this might be apparent from the financial statement, but many firms try to obscure this information to avoid competitors doing precisely what we are here aiming to do: understand the internal workings of their firm. Of course, workers also leave firms from time to time, and when you bring people on from another firm, you just might get the benefit of the information they bring to you from that firm. Don't forget the converse is true as well. Take care of your people. I think we can fairly say that we could put a table like this together, or at least create a reasonable estimates for each of the parameters. This is a very useful table. First, you can quickly see that by looking at the products that they are building, what market segment they are primarily targeting. It would appear that Ferris is adapting fast for the high-end market with its higher performance, lower size, and larger MTBF values. It looks like Chester's cake product is aiming for the same customers as we are with Able. We have a slight sales edge over cake, however, because we have set our price slightly lower. In the meantime, we see that Chester has added more automation than we have, while we have added more capacity. We will have more units to sell, but they will have lower unit labor costs than we will. We have tried to counter that advantage by lowering our MTBF to create lower material costs. Our total unit costs are, therefore, comparable to Chester. We've just opted to reduce our contribution margin to build a lead in market share, which was successful as we have sold more units and have a relatively lower inventory relative to our competitors. It now becomes more clear what kind of strategy we are pursuing. We are attempting to build market share through a low price point, accepting slimmer margins on hopefully more units sold. All the while, we are attempting to lower unit costs. This is a textbook cost leadership strategy. We have the early lead. We have discussed the market segment analysis several times in earlier videos. Now we will look at the bottom of these reports. Here we see the top products in the market segment. This is a useful table that summarizes a number of key figures from previous reports: units sold, market share, performance measures, price, and age. Also included are a few more key figures, which together paint a picture of the customer buying experience. First, we have a column indicating if we stocked out. This describes whether or not the demand for the product exceeded what we produced. Few things can upset a customer more than deciding to buy something and finding it that cannot be bought anywhere. This usually results in a loss of a customer. We want to avoid stockouts. We also see the promo budget and a measure of customer awareness, as well as a sales budget and a measure of customer accessibility. Demand increases the more customers are aware of your products and the better your customer service. The key figure in this section is at the right, where we find the December customer survey. This is a direct polling of our customers and how they rate our products. This is taken in December because presumably we will have sold through all of our previous year's inventory, and the feedback we receive is based solely upon the current product revision. This column combines all of the customer buying criteria, as well as the customer awareness and accessibility measures, into a single value. A higher value here is the key measure of how well you are delighting your customers. If your customer survey score is similar to that of your competitors, you are barely distinguishable from your competitors and therefore may be seen as more of a commodity. Lower values here indicate you simply are not competing effectively in the market segment. We will now skip past the market share report because I think it's mostly self-explanatory, as well as the perceptual map, which we have addressed previously. We now come to the human resources summary. Note that at this point in the game, TQM is not active, so we will not discuss it here. We will only look at a few key items here. The top line here is the needed complement, how many employees we need to fulfill our production schedule. Below are the number of workers broken down by first shift and second shift. Notice that when we are operating 2 full shifts, the size of the second shift is the same as the first. The second shift number decreases as the production schedule decreases. We then see the turnover rate, which is an indicator of how stressed your workforce currently is, resulting in separations. We also see the number of new employees and separated employees. Note that if you choose to automate, necessarily you will need fewer employees to work the assembly line, and your separations will increase, at least for a short period. We will discuss the real impacts of these decisions later in the course. The Foundation FastTrack report provides a great deal of useful information very quickly. Take the time to study these reports so that you may come to understand them. Even better, create pro forma reports at the end of each round and compare them with the FastTrack reports at the beginning of the next round. By doing this, you will be better able to understand why things didn't turn out the way you had originally anticipated. The great thing about games is that they lend themselves well to rapid trial and error. Experience is a great teacher, and you need to experience the stumbles. When something blows up in your face, you will remember the lesson. My goal for you is to experience all the stumbles you can while you're with me, so hopefully you'll be able to fly once you leave. Thanks for taking the time to listen to this rather extensive video discussing the FastTrack report, and we'll talk to you in the next video.